All right. So once again, we're going to be talking about periodic inventory and just inventory in general, real quick. Just recap of the first four chapters that we learned up so far. Everything else is basically those is the basic fundamentals of what accounting is, and it gives you the kind of guidelines on how to build the foundation, understand how a transaction works. But now, from chapter 5, this is where we're diving into specific territories where we're dealing with specific things that we're going to be journalizing. So, from this section on forth, we're going to be looking at inventory, right? Next time, we're going to be looking at what happens when we look at when people owe us money, okay, et cetera, et cetera. And this is where we're going to be building our idea of what is expected to be journalized. Okay, so here we are. We're going to be looking at periodic inventory purchases section. All right, so here we are. We again are focusing on merchandising inventory. Okay, so our main purpose is that we're going to be reflecting as if we are either the wholesaler or the retail store itself. Okay, so our main goal is that we're trying to buy a product. We're going to try to, add our own touches to it, and then we're going to resell it out to a public. So essentially, the idea here is that we're going to purchase already made goods, right? Because we're not going to be the manufacturer. We're just going to be the person who sells it out to the public. Okay, so we're gonna convert cash into goods, and we're going to convert goods into sales, which then converts sales into cash. All right, so that's the idea here. We're buying already made inventories items, and we're going to sell it out to the public. So we have two common ones again. We could either act as a wholesaler or we can act as a retailer. So the most common line of business when it comes to merchandising activities. Okay, so what is inventory? It's pretty much anything that you purchase with a purpose of reselling. Okay, so here is what's going to be involved into merchandising inventory. So the idea here is that it costs us money to purchase products, right? It costs us to on our end to purchase these goods, okay? And what's going to be involved in the costs could be a lot of things, right? So these are things that we're going to be taking a look at. For example, right? This is what we're going to utilize to calculate the cost of goods sold, or to also calculate the total cost it takes for us to purchase our inventory. So those costs can include obviously the price of the item, right? Sales tax if you do get charged, okay? Freight expenses, okay, also known as shipping, right? You may have special handling costs as well, and other things such as storage fees. So the list can be infinite of what the items that you're purchasing, especially if you go out and buy products from overseas, right? You may be subject to foreign costs, or you may have to pay that foreign special tax to import those items into the United States. Okay? So, most cases, as a vendor or as a manufacturer to merchandiser relationship, or vendor to customer relationship, you sometimes can be sales tax exempt. But most cases, like for example, Costco, right? Costco used to be the purposes for businesses, right, to purchase in bulk, and the businesses would get tax exempt. But nowadays, since Costco is now open to the actual general public, and it's been for a long time now, they decided to not exempt tax anymore. Okay, so few things there. Yes, so It really depends on who the customer is and who the vendor is. Again, you're the customer in this kind of aspect because we're making purchases of inventory. You may or may not get tax exempt, okay? But that doesn't mean that's not one of the options. Okay, so again, the definition of what the cost of inventory is going to be everything it takes to get the asset to your store. Okay, so whether it's shipping, handling fees, expedited fees, right? Let's say you paid extra to get the items to your store within 1 day. Okay, all of those are going to be considered expenses for you to make your purchase of inventory, and that's going to be included and calculated with your cost of goods sold. Okay. So once again, you definitely want to create your cost of goods sold for the purpose of when you sell your product, right? You want to make sure that all the costs it takes for you to get the asset to your store, you want to make sure that you don't have to pay that extra amount, that you have the customer, you know, in other sense, reimbursed you or cover those costs. Okay. So again, now we're going to be talking about how the ownership works and how shipping works, okay? So this is pretty straightforward. We have two types of ways that you can get shipped, right? You have FOB, which stands for freight on board, and then you have a second one called COD, which is cash on delivery. Now, most cases, a lot of the vendors that usually ship these items out to you, they either have their own shipping company or they do another third-party vendor to ship the items to you. So you could be billed for that shipping, but sometimes you might even have to pay cash for, upon receiving those items of inventory, So that's kind of like a secure kind of way to say, yes, I received the items. Here's your check. Boom. Okay. So that's cash on delivery. Where freight on board, right? It's usually when you can get billed for the delivery of the items. Okay. Now we're going to focus on how the who pays for what section and how the ownership gets transferred from the seller to the buyer. Okay, so the seller is going to be obviously the vendor that you buy it from, and it's going to start off at FOB shipping point. Okay, so as it travels from their store all the way to the midpoint, right? You are responsible to pay for the shipping. Okay? All right? And then once it gets to that midpoint, then right now from the midpoint all the way till it gets to your location, which is pretty straightforward, FOB destination, right? It gets to this destination, the ownership gets transferred over, and the seller is responsible to pay for the shipping. Okay, so most cases, like for example, Amazon, right? If the item does not get shipped to your, house or whatever location that you set it for, usually Amazon is responsible for either reimbursing you or for whatever reason replacing the items for you. So kind of understand it like that, all right? Instead of figuring it out like, oh, I paid for this, right? Because most cases when you do sign up for Amazon, right, if you don't pay for the Amazon Prime membership, you're responsible to pay like whatever X amount of shipping. But little did you know, both of you guys are responsible for paying for shipping, okay? If you ever sent out a package through UPS or FedEx, right, the shipping cost is very expensive for something so small, right? It's like $12 just to ship it, a small box, to another location. Okay, so you can expect that it takes a lot of money to ship a product over from one location to another, and that's why they generally have the rule of thumb here where they split the shipping, and you pay for your shipping just to get the product to the midpoint, and they pay for their part of the shipping to get from midpoint to your store. Okay? So, any questions here? Okay? All right. So again, the ownership, right? It leaves the minute it hits the midpoint. Okay? And the whole point is that when it gets to FOB destination, that is when you can officially say this is my inventory. Okay? All right. So now let's go ahead and talk about the inventory tracking methods. There are two inventory tracking methods that we will learn, okay? First is going to be the periodic inventory, and then the second one is going to be the perpetual inventory. Now, for this class, we are going to be learning both of them. However, we're going to look at one at a time. I'm not going to do both of them at the same time because I want you to understand one and then apply it to the other, okay? So how these tracking methods work is that, so for chapter 5 and 6, we're going to be dealing with periodic inventory. Chapter 7 and 8 is where we're going to look at perpetual inventory, okay? Now let's focus on periodic first, and then I'll talk briefly on the general idea of the perpetual inventory. However, we're not going to actually be tested on knowing the ins and outs of perpetual inventory until chapter 7 and 8. Okay, so first we're going to look at periodic inventory. So just like if you look up the definition of what periodic means, it literally means every once in a while. Okay, so periodically, so just exactly how it's describing, you're going to check or update your inventory every once in a while. So what that entails is that when we purchase a product, right, we don't care to keep track of it until one key thing. Someone goes down to at the end of the given period, someone has to go physically down to the basement or the warehouse or whatever, and they're going to take a physical count of the inventory. Okay, well, obviously, every time you make a purchase, you're going to keep track of that, so you at least know how much you have, theoretically, but to ensure that, someone's going to go down to the basement and count how many items you actually have in inventory. And what's going to happen here is that all purchases and sales are recorded, right? However, you're not going to keep track of the sales itself, because the idea is you're gonna update your inventory every once in a while. Okay, so what I mean by this is that when we look at sales, right, usually, right, we have to calculate how much we got rid of. In this case, we don't care. Okay, we only care that at the end of the day or at the end of the given period, someone goes down to the basement warehouse to take a physical count to ensure how much we actually truly have left in inventory. Okay, so again, most cases, right, at the end of every day or at the end of the shift, whatever type of retail store you are, you generally do take an inventory count, right? I know for most clothing stores, they must take inventory just to make sure that all the shirts are there, all the pants are there that they've ordered, and whatever they have out on the floor is reflecting on whatever they have written down in their books, okay? And here's the difference between the two. We're going to recognize our inventory as a purchase expense, okay? We're going to recognize it as an expense, okay? And then at the end of the given period, that's where we're going to take the physical count, we're going to calculate how much we sold, and we're going to figure out how much we actually are going to transfer into our inventory, okay? Now here's the difference between the periodic and then the perpetual. Perpetual, even if you look up the definition, it literally means constantly. So when we have the idea that we're constantly updating our inventory, that means all purchases and every sale that we make, we're going to constantly update our inventory. So that means Every time we sell something, we're going to update our inventory because we don't have that inventory anymore. We need to get rid of it. So we need to update our inventory. Every time we made a purchase of an item, we're going to increase our inventory. Okay? And that's how we keep track of our perpetual inventory. This one's a little more accurate, and it's definitely a lot more precise, and it's definitely a good business practice. Okay? However, I'm going to let you know you can utilize both. They're both correct. You can use them both correct. Okay? So, yes. And the difference here is that when you're dealing with a perpetual inventory, all purchases are going to be recognized as inventory or as an asset. It's going to go straight to the inventory. All right, but if everything's going to go straight to inventory, when you cost the goods sold and you have to take it out of inventory every time you make a sale, you're going to take everything out from inventory. Okay, so that's the difference here. One of them you're recognizing as an expense, the other one you're recognizing it as an actual asset. Okay, so for this example, once again, if you think about it this way, when you look at the inventory items that you purchase, like, think about how often do you sell this product. If it's something that you don't sell as often, then the best form of keeping track of it would be periodic. Okay, and then if you sell something constantly or use something constantly, you definitely want to use the perpetual inventory, especially if you plan to sell it out more often, because you should definitely take a look. Are you making enough purchases? With the sales that you've made and you're taking out of inventory, how quickly do you need to purchase more inventory just so that you have enough? Versus where a product that you don't really sell often, you purchase it, okay, well, if I don't sell it, then at least I know if I ever do sell it, then, or that occasion I do sell it, maybe I'll sell one or two of those items. But it's not going to be something that you are frequently going to sell. So think of it that way. Okay, so again, today for chapter 5 and chapter 6, we're going to take a look at periodic tracking inventory method. Okay, so once again, we're going to recognize it as an expense. Okay, all right, any questions so far?
For this chapter, we don't have the review exercises at the end.
What do you mean by the review?
The review exercises that you were giving at the end of the chapters that we went through last week.
So the review for this one, again, it's yes, it's just going to be the tables, because what we're going to be doing is we're going to practice utilizing the concept and recognizing, okay, we made a purchase, so this one we're going to practice how to journalize it. Okay. Yes, this isn't. I believe like a small section of it is like pretty much like a review. I'll ask you what are the two tracking methods. Okay. So, but it's not going to be like the first 4 chapters, where it's concepts that you need to know, or like I'll ask you, what are the 4 methods, right? In this case, it's practicing how to journalize. Okay. So. So here you go. So periodic, let's get started. Okay, so let's look at our first example here. Example number 1, on July 1st, XYZ company, we made purchase of 100 units of toys from Toys U. Okay, and each one cost $5.65 each, and freight costs, again, which is another word for shipping, freight costs you $100. Okay, so purchases were made on an account. Okay, so let's record this transaction. So remember, we're looking at 2 things here. We're going to practice looking at a purchase expense, which is going to be an account that we're going to use, and we're going to look at freight expense. So in this case, we need to keep our expenses separate as well. So that's the difference here. So if you had sales tax, you're going to have sales tax expense. If you're going to have expedited shipping expense, you're going to have expedited shipping expense. So every expense or cost that it takes you to get the product to the store, you're going to add on a new account. However, for this class, I'm not going to test you on anything other than purchase expense and freight expense, right? I'm going to keep it real basic and real simple. Okay? So from this exact thing here, here's my journal. How am I going to journalize this? Okay? Okay? So
Is
we
it up to anybody to discuss, or you want to just tell us?
that's what I'm saying. If you wanted to, if you think you know the answer, go ahead and blurt it out. If you don't, that's okay. I will go ahead and tell you. Okay.
Oh, okay. So I'm take my shot at it. So you can go toys you as a description.
Okay.
Um, this one's tricky because I was gonna put $565 as a debit, and then
Good.
um, and then again as credit $65 as the purchase, I
Good.
believe, and then the freight I would do another entry where I would put the freight cost, but I don't know if that's a debit or credit.
Okay, so remember what's our rule here? So if you got $565 on the debit side, but you have a $600 and 65 on the credit, where does that where should that extra $100 go? It'd be a debit, correct. Very, very close. You said freight expense. However, the first account, as we mentioned before, is going to be purchase expense. So you did very, very good for just giving a shot. So again, as I mentioned before, the accounts that we're going to be looking and utilizing in our journal will be purchase expense. And you're right, you need to separate them. So we, from this little information here, we took 100 toys and we multiplied it by the unit cost, which is the $5.65. Boom, right? Then we talked about freight expense for that $100. Now, if I placed it on an account, what is going to be my credit? The $665 is correct, but what account should I place it on if I placed it on an account?
Banking account?
Not banking account. We didn't pay for it just yet, remember?
Okay.
So the idea here is that we're making a purchase from a vendor, but we didn't pay yet.
It's gonna go under the description.
Okay, what account?
Accounts receivable?
Okay, so accounts receivable is for a customer who owes you money. You're very very close. What's the other one?
Would it be a liability?
It's a liability.
Payable?
Accounts payable, right? Because we're owing the vendor. Okay, so good. So accounts payable. So that's definitely a key term right there. When you place something on an account, the assumption is that you're going to owe them money. Okay, you're going to get billed for this amount right here. Accounts payable means that you owe them. So in this case, perfect. And that's how I build my journal, exactly like this. So I'm going to practice purchase expense, right? It's going to be whatever my purchase price was. Any costs that are included, such as my freight, is going to be separated on a separate line. And then I'm going to add them together to put it all on an accounts payable right here. Okay? All right? Everyone good so far?
Yes.
Okay.
Yes.
That's it for part one of that thing, okay? That's the how you build a journal, okay? Now, if you understand that, there's always going to be room for purchase discounts, all right? Now, of course, what do you mean by purchase discounts? Now, oftentimes when you have a great relationship with the vendor, they'll give you some special discounts or they'll give you, special offers that you can take advantage over. All right. And the most common one is that they'll give you things called terms. Terms means that it's pretty much an incentive to just pay the bill off. And by you paying off the bill, they'll discount the product that you purchased from them. So in this case, how you read this is that you will take a 2% discount if you pay the bill off in 15 days. If not, you have to pay in full in 30. Okay? So, let's look at this again. So, if I purchase those toys from my vendor and they offer me this discount, right? That means that example right there, I have to pay the full $665 within 15 days of my bill. Okay, so remember, you also get that little leeway where you'll get the bill. Oftentimes, the bill comes either with the product once it's shipped and it arrives your location. Oftentimes, you'll get the bill there. So, upon receiving the bill, it will list it on the bill itself of when the due date is. All right, and they'll even, if they're that good, usually they'll also put the discount date on there, so then they let you know, hey, if you pay within the whole thing in 15 days, you can take advantage of a 2% discount. And especially if you're buying in bulk, like large quantities, like thousands of an item, that 2% makes a huge difference. All right. Now, it also depends on whether we have enough money to be able to pay that $565 off within the first 15 days. But you have to know, if you miss that, then you have to pay the whole thing in 30. So it's kind of like an idea, well, if you pay now, you get an incentive. But if you pay later, you don't get any penalties. But of course, if you pay after the 30 days, you will get fined. Okay? So again, terms are made for the reasons for it, to give either vendors or customers, right? So we can also use this when we make a sale to our customers too. That this is basically an incentive to just pay us back, especially when you do some kind of business like this. If you're pending on a $600 bill, right? You definitely want your money as soon as possible, especially if you have the notion where it's a possibility that either the customer or the vendor can fault on their payment, right? If I'm the customer and I receive this, right, I may not be able to pay for it. So that's kind of like one of those ideas too, that you want to make sure that this is to ensure that they receive the payment. Okay, so that's that right there. You get a discount if you pay within 15 days. So, like I've mentioned, there are two methods behind on deciding when to record the discount, especially when we deal with terms. So we have the net method and we have the gross method. Okay? The net method is pretty straightforward when it comes to someone who's really good at paying their bills. Okay? So for example, right? We so and so has a bunch of bills, right? We got a bill that's due on the first of the month. We got a bill that's due on the 25th of the month, and then we have one that's due, I don't know, on the 15th of the month, right? The net method is for people who can and make a lot of money and that can afford to just go ahead and write the check off right then and there upon receiving the bill, so they can take advantage of the discount. Okay, so with that kind of type of accounting, right, what they decide is, well, if I'm going to be really good and pay my bills on time, I'm going to ensure that I will get that discount. So what I'm going to do is I'm going to take the discount immediately. All right, so that's the net method. Now the gross method, right, is common amongst, smaller businesses, because again, every bill that you pay, you kind of have to make sure that you have enough money and to ensure that whatever you know, priorities come first. That if this bill is a priority, you want to pay it when the due date is there, right? Because the one thing is that this one is just in case like you're gonna record it, and if you make the discount, then you make the discount. If you don't, that's okay. So this is one is for when you're not quite sure if you have enough money to go ahead and just pocket out that $600, right? So in this case, general rule of thumb is that the best way to do it, if you're not sure that you can pay the bill on time to make the discount, then you should use the gross method, which is when you record it, you're going to record it at regular price, and then if you happen to pay at time of when you get the discount period, then you can go ahead and take the discount later. You're not obligated until later. Okay, so we're going to take a look at both methods so then it's kind of clear of what I'm trying to do here. Okay, so first we're going to take a look at the gross method. So here, my idea is that on February 1st, you decide to purchase 100 coffee mugs on an account, okay, from Cuppy's Co. Okay, and it costs you $1.25 each, with a freight costing you $100. Terms are 5%, 10, net 30. Record this transaction. So again, gross method is we're looking at taking the discount later. Now, let's ignore the terms and just record as usual. So what's my journal going to look like? Right? How?
Okay,
Okay, go for it.
I'm going. Okay, so it's going to go February 1st.
Good.
Description is coffee cups.
Mm. What do we treat our inventory?
Coffee mug.
No. What do we treat our inventory?
Purchase.
Purchase what? Purchase expense. Right. We don't recognize it as inventory. We recognize it as a purchase expense. Okay? What else?
So that the price would be $125 a piece. I don't know if that's correct. And the debit would be $125.
Good.
And then underneath, freight
Good.
would be $100.
Good.
And that's where I'm stuck. So I'm listening.
Okay. We placed it on an account. So what's my total amount that I owe?
225.
$225. But this time, what's my account going to be?
What do you mean?
Account payable.
Account payable, correct. Because we made a purchase, right?
Yes.
We bought it from the vendor. Therefore, we received the bill. We owe them money. We didn't make a payment yet. That's where the terms are going to come into play, okay? So for right now, we're just only focusing on recognizing that we made a purchase and it's on an account. So in this case, exactly how we discussed it, right? We got purchase expense, we got freight expense, and we placed it on an account. So therefore, it's an accounts payable. We owe the money. All right? So in this case, we're increasing our liabilities, but we're also increasing our expenses by debiting our expenses and we're crediting our liability. So in this case, exactly how you said it, 100 times 125 gives you 125 plus the $100 freight gives you a total of 225. So that is just recognizing the purchase itself. Okay? Now, here's scenario number 1. Let's say it's February 9 and we decided to just pay Cuppy's Co. in full with the check for the purchases that we made, right? So, and then again, once again, the terms are 5%, 10, net 30. So in this case, did we pay within the discount period?
Yes.
Yes, because the term here is that we were supposed to pay within 10 days. Right? And we did. We paid on the 9th. We paid in 9 days. So we made the discount period. So now we're going to pay off our liability. And we're also going to recognize another account. It's going to be a contra account. All right. And what we're going to be looking at is going to be a purchase discount. Okay. So here, I already recognize that I made my purchases inventory, right? So now the only thing I have left to do is pay for what I owe. So in this case, I owe a grand total of $225. That does not change, okay? Because whatever you owe, you owe. Okay? So here, because I'm paying it off, I am decreasing my liability because I don't owe this company anymore. I'm paying them off. Okay? Now, however, I'm receiving a 5% discount, right? Because my terms was 5%, 10, net 30. So in this case, I'm paying it as of February 9, meaning I made the discount period. So therefore, is my check going to be for the full amount?
No.
No, it's going to be less than that. So here, now the general rule of thumb here is that what can you discount? In this case, go ahead.
No. Okay, yeah, I'm like, well, we'll get discount freight now. That makes sense.
Yes, exactly. I was just going to touch on that point. You cannot take it. Yes.
It's gonna be this like 11 something, ain't it? And I'm like, yeah, okay, makes sense.
Yes, shipping is standard. It's just like going to the UPS store. Can you ask them for a discount for shipping? No, they're gonna laugh at you.
You can always ask, they can always say no.
They're always gonna say no because shipping is always it's set price. Exactly what you said, or it's based on how big the package is and how heavy it is, right? You could choose those options, but obviously it's a set price. You can't haggle and say, hey, yo, buddy, can you discount me on this shipping? No. All right. So you absolutely cannot discount shipping. So in this case, what can you discount? Only the original purchase price. So in this case, right, if my original purchase price was 100 times $1.25, which gave us a total of 125, right? We can only discount 5% off of this $125. So in this case, I calculated it, and it gave me $6.25. Okay? So with that $6.25, I'm going to credit my purchase discounts because, again, purchase discounts is going to be a contra account to purchase expense. Okay? So essentially, just exactly how we journalized it in the first place, right? If we journalized our purchase expense as 125, we're going to create a contra account to decrease our purchase expense, right, by $6.25. So therefore, I only pay $218.75. Okay? All right? So that's what happens when you pay within terms and you make the discount period. Okay? Is this okay? Is this pretty clear?
Yes.
Okay? So again, when you make a payment on something that you owe, you have to recognize first what is the amount that you owe. Then if you made the discount period, you're going to recognize. If you made the discount, you need to create a contra account to decrease your main account, which is the purchase expense. And then obviously you're going to write a check for the less amount. So that's always rule of thumb. If you made the discount, you are going to write a check for the less amount. Okay? So that's just scenario 1. Now let's say scenario 2 comes around and let's say instead of paying, so ignore the scenario 1, this is scenario 2 now. Let's say I paid on the 15th of February. So I just barely missed the discount period. So here again, once again, you're going to pay Cuppy's Co. in full with a check for the purchases that you've made. Terms are once again 5%, 10, net 30. So because we just missed the discount period, how are you going to recognize paying this vendor off.
You would do accounts payable for the full price of the 225.
Okay, and then what account?
And on February 15th, of course.
Yes, of course. Exactly what Alan has said. You're going to recognize the accounts payable for the full amount, and you're going to pay for the full amount. No penalties because you just didn't make the discount. That's it. Okay? So that's straightforward. So commonly practices will be using the gross method more so than the net method. The net method, which is what I'm going to introduce right now, it only saves you time to enter in another entry. All right, so let's go ahead and take a look at the difference between the net method now. Okay, so now the net method, same exact scenario, except let's just take a look. So net method, so here you go. On February 1st, once again, you decided to buy 100 coffee mugs on an account from Cuppies Co. That cost you $1.25 each. Freight, once again, is $100. Terms are 5%, 10, net 30. Record this transaction. So, when we look at the net method, our assumption is that we're so good at paying bills that once we receive this bill, I'm going to pay it within the next couple days. So I am going to recognize the discount now. So in this case, how do you think I'm going to journalize this?
February purchase expense,
Mm-hmm.
25, and then freight for 100.
Okay. That's a good try, but remember, we're taking the discount now.
Your purchase would be the 118.75 under purchase expenses.
Correct. We're taking the discount now because our assumption is that we're going to pay this bill off in the next couple days. We're not going to even bother what the terms are. We're just going to take the discount now. Okay? Because, again, the idea of using the net method is that we're essentially saving ourselves another transaction that we have to write in our books to take the discount out. So in this case, I'm just going to take it right out. Okay? And then, so if I take my discount now, so then when I actually make my payment on February 9th, what's going to happen? How are you going to journalize that you made a payment on February 9th?
So we just put the February 9th
Mm-hmm.
inventory. Sorry, I was with the accounts payable.
Correct.
The 218 and change.
Perfect.
And yeah.
That's exactly what you're going to do because in this case, right, from the gross method, we didn't take the discount yet. So when we paid, we took the discount then. In this case, I already took the discount out. So in this case, February 9th rolls around, I cut them a check for the amount that I owe them, which is going to be the $218 because I've already included the discount right then and there. Okay, so no contra account needed. Okay, unless, what happens if you accidentally miss that payment? Okay, so I already took the discount off, and in this case, I completely forgot about writing the check, and it's February 15, and I'm just like, oh my gosh, I better pay them off now, and I missed the discount period. All right. So how do you think I'm going to journalize this time?
Now, did we agree on a term after 30 days, was it a 5% increase or anything like that? If we're not given the information, it seems like an algebra equation.
Well, no, you would still do the accounts payable for the 218.75, but then since you were talking about before about contra accounts. So put the was it like 625 in the purchase discounts loss.
Yes. Good. That's absolutely correct. So in this case, we missed the discount period, right? Since, on the original bill, it's not going to say that you owe them 218. It's going to say that you owe them 225. But because on our books, we said that we were so good at paying our bills, we decided to take the discount on our terms and say, hey, I know I'm going to pay them within the next couple days, so I don't even need to worry about entering in another discount. So in this case, I took it right off immediately. But in this case, I forgot to pay and I end up missing the discount. So now I have to pay more, or essentially pay what the original bill was set out for. However, here in my accounts payable, I've recognized that I paid them. I was planning to pay them at the discounted price. All right. So again, this purchase discounts loss is actually a contra account. Two contras, right? So this is a contra account to the purchase discount, right? Which is a contra account to purchase expense. So in this case, because a contra and a contra, so that means if purchase expense is debited, the contra account is credited. This is a contra account, so this becomes debited once again. Okay. So again, that's exactly what you're going to do is in case you do end up writing the net method and you end up missing that pay period, you do have to create that extra account to recognize that you actually have to, the actual inventory it's at price is 225 versus 218. Okay. So again, this is a common practice that some, again, companies do, so just so then they can cut corners and not have to journalize more. But in this case, general rule of thumb is best way to ensure that everything goes through perfectly fine, use the gross method. Okay, when in doubt, use the gross method. Don't try to do the net method if you are not sure that you can pay within a few days after the bill. Okay. Any questions on the difference between the net and the gross method? Okay, good. All right, so chapter review. So we got to take a look at inventory itself, right? We know that the cost of inventory is everything it takes to get the asset to your store. All right, we got to take a look at the two different shipping methods, right? FOB shipping point and FOB destination. Okay, we also got to look at the two different types of shipping, FOB and COD, cash on delivery, freight on board. We also got to take a look at two different types of tracking methods. So we got to look at periodic and we got to look at perpetual. Again, because chapter 5 is dealing with just periodic inventory, we're only focusing on one aspect, which is going to be journalizing a purchase expense, freight expense, and if it's placed on an account, you place that it's on an account. Okay, so there's your perfect example right here that you could always refer back to. Okay, and then of course we got to take a look at how the net method and the gross method are compared by side. One is we're taking the discount immediately. The other one, we're taking the discount later. So we just took a look at that. And here, there's some few things that you can know. You cannot discount freight or anything else, okay? Terms, once again, is basically you take the discount if you pay within a certain amount of days. If not, you must pay the whole bill in full within X amount of days. Definition between net and gross, pretty straightforward. If you think about it in terms of wages, right? Your gross wages is everything that you earn in full. Your net wages is going to be after all the taxes has been taken out of your check. So think of it that way, okay? And of course, that is it for chapter 5.1. Any questions? Okay, so let's go ahead and take a look at our exercises here. Okay, so yep, here we are. So we're going to be practicing journalizing our entries here. Okay, so first things first is question number 1 says that journalize. Okay, assume that all purchases were made with cash. Okay, so here I'm specifying exactly how you paid the items for. So in this case, we're not going to be dealing with any accounts just yet. We're dealing with just our purchases. Okay, so the first one here is we're going to practice that on April 5th, we purchased 1,000 units at $5 each with a freight cost of $100. So how am I going to recognize this transaction or journalize this transaction?
You start with the date, 5 April.
Mm-hmm.
You use your purchase expense
Mm-hmm.
for $5,000.
Okay.
And then underneath, you would also put the freight for $100.
And then how did you pay for it?
There, you would indent in cash account.
Good. All right, because we paid in cash. Go ahead.
Yes. For the credit, right, 5,100.
Good. Okay. Like I said, I just want you guys to just practice journalizing. Descriptions will get into use when we keep diving into later chapters, okay? So in this case, you don't have to have a description unless you choose to. So a perfect description could be that I purchased 100 units at $5 each. Straightforward. Okay. What about the next scenario here? On April 10, we purchased 750 units at $5.75 each, with a freight costing you $75.
Hi, Felipe, I'm in. Hi. So April 10th,
Good,
description, purchase expense.
good.
I'm using my computer, my calculator on the side, so I'm not gonna lie. So the purchase or debit's gonna be $4,312.50.
4,000.
12, $4,312.50.
Good.
And then of course the expense, $75.
What kind of expense?
Freight.
Good. Make sure you're specific because there's a lot of other expenses out there. So good. And for $75. So what is the total amount?
$4,387.50.
Good. And we're going to play with cash. So 4,003, what was it, 87?
Yes.
Oop. And 50 cents. Excellent. Okay. So what happened next on April 20th? We purchased 200 more units at $6 and freight was $20. So how am I going to recognize this one?
Purchase expense.
Good. Purchase expense.
For $1,200.
Good.
And then your freight expense for $20. And then you indent and put cash for $1,220.
Good. Excellent. Last transaction here is going to be April 25th. We purchased 500 units at $6.25 each with a freight of $50. Okay, so 425. Anybody can do it.
We ain't trying to take up all your time.
No. That's fine. I can. Yeah. This is for you guys.
You need a purchase expense
Perfect. Purchase expense
for $3,125.
for what was that? 300?
No,
3,000?
$3,125.
Good.
And then a freight expense for $20. Oh no, I'm sorry, $50.
Good. $50. Oop.
And then you indent and put cash. And under credit, then you put $3,175.
Excellent. Oh, wait, 375. 3175. Good. Excellent. So again, once again, if you did have your little descriptions, then, extra space for you. But good. Excellent. So that's exactly how we journalize a purchase of inventory. Okay. So once again, here's question number 2. What costs are included when making a purchase of inventory?
Would that be your freight and your purchase?
This is
All expenses.
correct.
Expenses.
Ooh, I hit the wrong one. Okay, so all expenses. Keep going. Elaborate. What are these? All the expenses. What do they do?
Oh, for the purchase of the inventory.
Mm-hmm. So included. Okay. What's that one keyword that I said that you have to have on here?
Ex- all expenses including per. Oh no, I'm out.
Okay. Think about the shipping point and the shipping destination.
Oh, like cash on delivery and
Yeah, and FOB.
Mm-hmm. So in this case, it's going to be every single expense it takes to get, okay, inventory, to get, right? Right,
so
to
this
get,
would include like tariffs or something if I get something from China.
absolutely. Mm-hmm.
Okay, shipping's like $7, but there's tariffs of 5.
Absolutely. So foreign costs, yes. Or foreign taxes, we call them. Other things that can be if, let's say, I need the product by 2 days from now, I can expedite that. And obviously, it's going to cost you a lot more, like a lot more if you expedite those costs. So yes, remember they have standard shipping and then they have expedited shipping. What's the difference between that? A huge difference. Okay, and let's say if you have you buy fragile items, you may be subject to have special shipping and handling costs. So making sure that the package is like in like the styrofoam stuff, right? That's going to be an additional cost to shipping your items. Okay, sometimes it's included, sometimes it's not. You may have to request it, right? So good. So it's going to be every expense that it takes to get the inventory or to the asset to the store. Okay? Perfect. All right. Question number 3 says, what are the 2 tracking methods of inventory?
Periodic and perpetual.
Correct. So periodic. Excellent. Okay. Number 4. Okay. So what does net method mean?
Total discount on. Oh man, it says take. Sorry. So I
Take
put
discount on everything.
Excellent. Take discount immediately. Yes. That's the best way I can make it so that it's easy for you to understand. You take the discount now versus later. Okay? So here we go. Using the gross method of for periodic inventory, okay, if you made a purchase on April 5th, okay, of 1,000 toys at $5 each, right, with the freight costing you $100, okay, on an account, and the vendor decides to give you terms of 5%, 15, net 30, journalize this transaction. April 5th.
We made the purchase of 1,000 toys at $5 each, so that
Mm-hmm.
would be for $5,000. And then underneath, you would still put your freight cost for $100 for freight expense. And then this is where I'm lost.
Okay, so we placed it
In cash.
not cash.
Oh
This is
yeah,
what we're gonna
okay.
pay. Yeah, cash. So it'll be $5,100.
Okay, so we didn't
Account.
Would be on account payable.
absolutely accounts payable. Yes. So good. Accounts payable because we owe them the money. And because we owe them the money, they're going to give us a special term. Okay? So it's only applied if you end up owing them money. All right? When you receive a bill at the end of the day, they give you an incentive saying, "Hey, I'll give you an additional discount if you pay within 15 days." But think about it. Who's going to have $5,100 in their pocket?
Not me.
Exactly. So in this case, that's why we got to say, well, let me make my payment to my rent first, and then I'll deal with you later at the end of the month. Okay? And that's where sales comes into play because then you'd be able to pay for that. So in this case, I'm going to write to make sure that I know that, again, who my vendor is, right? Cuppies Co., right? I made a purchase of 1,000 mugs, right? At $5 each, right? And here, this is where I'm going to place my terms in here. So then the next time I look at this, I'll know exactly what my terms are. If I pay within 10 days, or no, 15 days, right? If not, the whole thing is due in 30. Okay, so net 30, right? So there it is. So here, I'm recognizing who I owe, what I owe, right? Because remember, if we take the discount, what price can I discount it at? I can only discount the $5,000. Okay? So then now continue with question number 5, and you paid the vendor on April 15. Journalize this transaction. So what happened on the 15th? How many days is that? Mm-hmm.
So you get a $250 discount.
$250 discount, which is 5% of
5,000.
good. 5% of 5,000 is 250. So where am I going to put that 250? Credit. Good. Okay, so 250 for credit. All right, but now let's recognize what are the accounts I'm going to be using. I'm paying off what I owe.
Account payable.
Accounts payable.
Good. We're reducing what we owe, so we're paying it off, so therefore we are going to decrease it with a debit. And for what full amount am I going to recognize this for?
4,750.
Okay, remember, what did we originally journalized it as? 5,000 what?
100.
5,100. Okay? Now, we recognize that we have a purchase discount, right?
Is the freight included or no?
Let's take a look. Purchase, sorry, discounts. Okay, now let's take a look. My 5,100, what does it include?
The freight.
The freight. Good. Here, she only took the discount off of the $5,000. Not including the freight, because you can't discount freight. So in this case, I'm paying within terms, so that means I get a 5% discount off of not the grand total.
Would it be 5,000, not $5,100 on the debit?
Well, let's look at this. So if let's say okay, I'm gonna eliminate this, right? If I were to take that $250 discount, how much am I gonna actually pay? How much am I actually gonna pay? So I'm assuming I paid with a check because there's no way I'm gonna give that much money by cash. So how much money am I gonna actually pay this vendor?
4,850.
Okay, 4,850. 485. Okay, what's my grand total that I owe?
5,100.
I owe 5,100. I don't owe just 5,000. I have to pay for the freight too. So in this case, what I owe my vendor is going to stay whatever I recorded it as. Because technically I can't say I'm going to pay off 5,000 out of the 100. Where's that extra 100 going to go? You still technically owe the company for the shipping. So in this case, whatever that you've originally purchased and you marked as what you originally owe is going to be what you're going to actually reflect when you pay it off. Now, of course, yes, you can make partial payments, but in this kind of scenario, I don't want to talk about partial payments. I'm talking about paying the whole thing off. Okay? So in this case, the amount that I owe Cuppies Co. is reflecting at a bill of a 5,100. But I received a discount, so I'm not going to pay them for the full amount. I'm going to pay them including my discount. So therefore, I'm going to only pay $4,850 because I received the discount. Okay? Does this make sense?
Yes.
Okay. Okay. So then here's number 7. Now, instead of doing that, using the information from question number 5, journalize the purchase using the net method. Okay, so I'm going to push this forward real quick so we can take a look at our stuff. So, if I'm using the net method, right, and I'm journalizing the purchase on April 5th, which was the 1,000 toys, okay, for the $5 plus the freight of 100, and my terms are still the same. 5% 10, 5% 15, net 30. So again, how am I going to journalize it this time? But I'm using the net method.
Purchase expense.
Purchase expense, good.
And then it'll be $4,750.
$4,750. Good.
And then freight expense, $100. And then we come to accounts payable, $4,850.
Good. $4,850. So here I recognize that I only owe $4,850, opposed to from above, I recognize that full price until I paid for it. Then I recognize my discount, and I end up paying $4,850. In this case, right, the difference here is my gross method. There's 2 journal transactions I have to write. I have to write it for the original cost, and then I have to create a contra account if I meet that discount. All right? Where in this case, I already took the discount right then and there. So all I have to do is just pay for it. For the $4,850. So that's the true difference between the gross and the net method. The only thing is that you just eliminate space in your journal. All right? Last but not least, okay, what does terms mean? If 2% then net 20.
You receive a 2% discount if you pay it by the 10th of the month,
Not the 10th of the month.
the 10th day of the month, or the 10th day.
Mm-hmm. If not,
And then you pay the 20%,
what do you pay?
the full amount.
The full amount. Good. So take a 2% discount if paid in full within 10 days. If not, pay in full in 20 days. Okay, or in this case, it's supposed to be take 2% discount if you pay within within 10 days. If not, pay in full in 20 days. Okay, excellent work, guys. Okay, so again, we're introducing things one at a time. So this is what happens when we purchase periodic inventory. This is how we recognize it in our books. Okay, and this is also how we recognize it. The key term here is when we place things on an account. And we got to take a look at when we're giving terms. All right, so good. Any questions so far on this particular section right here?